For the last decade, private credit has been one of the biggest success stories in finance. Investors were promised attractive yields, lower volatility, and diversification away from traditional markets. And the money followed. Pension funds, insurance companies, family offices, and wealthy investors poured hundreds of billions of dollars into private lending. But there is a question the market has not had to answer for years. What happens when the loans created during an era of cheap money have to survive in an era of higher interest rates? Because some of the biggest risks in private credit do not appear on a daily price chart. They are hidden inside loan structures, valuations, borrower balance sheets, and the ability of investors to actually access their money when conditions change. To understand where the risks may be emerging, you first have to understand why private credit became so popular. After the global financial crisis, banks pulled back from certain types of lending as regulation increased and balance sheets became more constrained. That created an opportunity. Private lenders stepped in to fill the gap. Firms like Apollo, Ares, Blackstone, KKR, and others built enormous private credit platforms. The pitch was attractive. For many years, this strategy worked extremely well. Capital poured into the sector, and private credit became one of the fastest growing areas of global finance. Before we get into where those risks may be appearing, if you find this type of analysis valuable, make sure to subscribe and turn on notifications. I am particularly interested in hearing from people involved in credit markets and institutional investing. Now let's look at where the pressure points are starting to emerge. A large portion of private credit grew during a period of historically low interest rates. Companies could borrow at attractive terms and refinancing was easy, but the environment has changed. Interest rates moved sharply higher, and the question facing many borrowers is simple. Can companies that borrowed in a low-rate world continue to service their debt in a higher-rate world? A loan does not become risky overnight, but the economics surrounding that loan can change dramatically. Higher interest expenses can pressure margins. One of the biggest differences between public and private markets is price discovery. In public markets, assets are constantly repriced. Private assets work differently. Many private loans are valued using models rather than daily market prices. This does not mean valuations are wrong, but it means investors need to understand the difference. Understand the difference between less volatility and less risk. Those are not always the same thing. Sometimes volatility is simply delayed. One area getting increased attention is PIK, or payment in kind interest. Normally, a borrower pays interest in cash. But under a PIK structure, the borrower can add the interest owed to the loan balance instead. The lender records income. The borrower avoids making cash payments today. On paper, everything can look fine, but the question becomes, are investors receiving income, or are they receiving a promise that the borrower will eventually be able to pay? In an environment of higher rates, PIK structures deserve closer attention. Credit markets are built on one fundamental assumption: borrowers will generate enough cash flow to repay. When economic conditions weaken, that assumption gets tested. Higher rates increase borrowing costs. Inflation pressures operating expenses. Publicly traded business development companies, or BDCs, provide an interesting window into private credit. They hold similar loans, but trade publicly. When investors become concerned, share prices move. Risk gets repriced. The public market is basically saying, we don't believe the model. In stressed markets, some funds may limit withdrawals or put up gates. And that leads to the biggest question. What happens when everyone wants liquidity at the same time? This issue becomes even more important when you look at the AI infrastructure boom. Building data centers requires enormous amounts of capital. That capital is increasingly coming through private markets. The question is not whether AI is real, but whether the financing structure supporting it can deliver the expected returns. Private credit is not disappearing. It plays an important role in modern finance. But every credit cycle eventually asks the same question: were investors properly compensated? Risk does not disappear simply because an asset is private. Sometimes it just becomes harder to see. If you found this analysis useful, subscribe and stay tuned.